Hello! Welcome to Capital Sensei. Today we are going to dive deep into one of the most powerful and frankly, life-changing investment books ever written, 100 to 1 in the Stock Market by Thomas Phelps. We'll unpack his core philosophy of how to find companies that can turn every dollar you invest into $100. We'll talk about his mantra of buy right and hold on. The immense psychological challenge of not selling your winners too early, and the specific characteristics you should look for in a potential 100-bagger. Whenever we can, we answer questions in the comments. This book can spark a lot of what-if scenarios and personal questions about your own investment journey. So, as we go through this, if anything comes to mind, or if you've ever had an experience trying to hold a stock through thick and thin, share it down below. Your stories and questions create a community where we can all learn from each other. Let's start with the man himself. Thomas Phelps wasn't just some academic in an ivory tower. He was a man in the financial trenches. He started as a journalist, even heading the Wall Street Journal's Boston News Bureau, and later became an investment advisor. He saw the Great Depression, World War II, and the massive economic boom that followed. He lived through incredible market cycles, and his wisdom comes from decades of first-hand observation and practice. He published his masterpiece in 1972, distilling a lifetime of experience into one powerful idea. That idea, the very heart of his philosophy, is deceptively simple. Find a great business, buy its stock, and hold on. But it's the details within that phrase that make all the difference. He wasn't just saying, buy and hold, a phrase you hear thrown around all the time. His mantra was buy right and hold on. The buy right part is the real work. It's the detective work you do up front to ensure the company you're investing in has the potential for greatness. The hold on part is the test of your emotional and psychological fortitude. Think of it like planting a sequoia tree. You wouldn't just scatter seeds on concrete and hope for the best. You'd carefully select the healthiest, most promising seed. That's your research. Then you'd find the most fertile soil with plenty of sunlight and water. That's the industry and economic environment. You plant it and then you wait. You don't dig it up every week to see if the roots are growing. You trust the process. Selling a great company after it doubles is like cutting down that sequoia when it's just a sapling, missing out on the towering giant it was destined to become. So what exactly is a 100-bagger? This legendary beast Phelps talks about? It's an investment that increases in value to 100 times its original purchase price. Let's make that concrete. If you invest $1,000 in a stock and it becomes a 100-bagger, your $1,000 turns into $100,000. If you are able to invest $10,000, that becomes $1 million. This is the kind of life-altering return that can create generational wealth from a relatively modest starting point. It sounds like a fairy tale, but Phelps cataloged hundreds of these companies that actually did it. Now, your brain might immediately think a stock needs to have some impossibly explosive growth to achieve this. But the math is more patient than you think. This is the magic of compounding. A stock that grows at a steady 26.5% per year will become a 100-bagger in roughly 18 years. If it grows at 20% a year, it takes about 25 years. This isn't about finding a stock that goes up 200% tomorrow. It's about finding a quality company that can grow consistently for decades. So how on earth do you find one of these needles in the haystack? Phelps laid out some clear characteristics to look for. The first, and maybe most intuitive one, is to start small. A $10 million company has a much clearer path to becoming a $1 billion company. That's your 100-bagger right there. Then a $500 billion behemoth has to become a $50 trillion company. The law of large numbers works against giant corporations. Think of it like a speedboat versus an oil tanker. A small, nimble speedboat can accelerate rapidly and change direction on a dime. An oil tanker is massive and powerful, but it takes miles to turn and even longer to get up to speed. The small companies, the speedboats, have the agility and the vast open ocean of market share to capture. You want to be on board before it's a household name, not after. Next, the company must possess a truly powerful and durable competitive advantage. This is often called a moat, a term popularized by Warren Buffett, who was a huge admirer of this way of thinking. A moat is something that protects the company from competitors, just like a real moat protects a castle. It allows the company to maintain its profitability and fend off rivals who want a piece of the action. This is absolutely critical for long-term survival and growth. What do these moats look like? They come in several forms. It could be a powerful brand like Coca-Cola. People will pay a little more for a Coke, even if a generic soda is right next to it. It could be a network effect, like with Visa or MasterCard. The more people use their cards, the more merchants accept them, which in turn encourages more people to get the cards. The network becomes stronger with every new user. It could also be a patent on a breakthrough technology or a new drug, giving a company a legal monopoly for a period of time. Another type of moat is having a low-cost advantage. If a company can produce its goods or services significantly cheaper than anyone else, it can either undercut its competitors on price or enjoy much higher profit margins. Think of how Walmart grew by being relentless about cost-cutting and passing those savings on to customers. A company with a deep, wide moat can reinvest its protected profits for years and years, compounding your wealth along the way. Without a moat, success is fleeting, as competitors will quickly swarm in and erode the profits. Beyond the business itself, Phelps insisted you must bet on top-notch management. You are entrusting your capital to these people. You want to see a leadership team that is not just competent, but visionary. Are they pioneers in their field? Do they have a clear, long-term plan for the company's growth? And very importantly, do they have significant skin in the game? When the founder or the CEO owns a large chunk of the company's stock, their interests are perfectly aligned with yours as a shareholder. They want the stock price to go up just as much as you do. You want a jockey who loves the horse. A manager who is just collecting a salary might make safe, uninspired decisions. A founder-owner will treat the company's money like their own because it is. They will be more likely to make the bold, long-term investments necessary to achieve that 100-fold growth, rather than trying to hit some arbitrary quarterly target to please Wall Street analysts. Looking at the character and incentives of the management team is a crucial piece of the buy right puzzle. Now for a slightly more technical point, but stick with me because it's like a secret weapon. Phelps looked for companies with a high and sustainable return on equity, or ROE. Don't let the term scare you. It's actually a very simple and beautiful concept. Imagine a company has a little money-making machine. The equity is the money that's been invested into that machine. The return is the profit that the machine spits out. Return on equity simply tells you how efficient that machine is. Let's use a pizza shop analogy. Tony's Pizzeria is built with $100,000 of invested capital. That's the equity. At the end of the year, Tony makes $20,000 in profit. His return on equity is 20%. Now, Marco's Pizzeria is also built with $100,000, but Marco is a genius. He makes $50,000 in profit. His ROE is 50%. Which business would you rather own? Marco's, of course. His business is a much better money-making machine. A company with a high ROE can grow much faster without needing to borrow money or sell more stock. It's a self-funding growth engine. It takes its profits, which are already high relative to its size, and reinvests them back into its high-return business, making the whole enterprise even bigger and more profitable the next year. It's a virtuous cycle. Finding a company with a high ROE and a big opportunity to reinvest its earnings is like finding a financial fountain of youth. So, let's say you've done the work. You found a small company with a huge market opportunity, a deep moat, and a brilliant owner-operator at the helm. You've checked the financials, and it has a fantastic return on equity. You've bought right. Now comes the hardest part of the entire process: holding on. This is the great psychological battlefield where most aspiring long-term investors are defeated. The journey of a 100-bagger is never, ever a smooth, straight line upwards. There will be terrifying drops. The stock market will crash. The economy will enter a recession. The media will declare your company's industry dead. Your stock might fall 50% or 70%, or, in some famous historical cases, over 90%. Every instinct in your body will scream at you to sell, to cut your losses, to just get out and stop the pain. This is the crucible. This is where patience is forged. Let's look at a real-world example that everyone knows: Amazon. If you had bought Amazon stock in 1997, you would have seen it skyrocket during the dot-com boom. You'd feel like a genius. But then, between 1999 and 2001, the bubble burst. Amazon's stock price collapsed by more than 94%. It went from over $100 a share down to less than $6. The media was filled with stories about how it was going bankrupt. Imagine living through that. Imagine watching your $10,000 investment shrink to just $600. The pressure to sell would have been immense, almost unbearable. But the people who truly bought right, who understood that e-commerce and cloud computing were the future, who believed in Jeff Bezos's long-term vision, and who had the fortitude to hold on, were rewarded on a scale that is almost impossible to comprehend. That 94% drop is now a barely visible blip on its long-term stock chart. This brings us to one of Phelps's most famous quotes, which perfectly summarizes his entire philosophy. He said, "To make money in stocks, you must have the vision to see them, the courage to buy them, and the patience to hold them." Patience is the rarest of the three. Let's break that down. The vision is the research, the buy right part. It's seeing the potential in a company that others miss. The courage is pulling the trigger. It's investing your hard-earned money, often when there's fear and uncertainty in the air. It's easy to buy a stock when it's going up every day, but the best prices are often found when things look bleak. The courage is acting on your vision. But then there's the patience, holding on for 10, 20, or 30 years through gut-wrenching volatility, through periods where the stock does nothing for years on end. That, as Phelps said, is the rarest and most valuable quality of all. This directly challenges one of the most common and, according to Phelps, most destructive adages in finance: you can't go broke taking a profit. Phelps would argue that you absolutely can. You won't go broke in the literal sense of losing your initial capital, but you can go broke in terms of opportunity cost. You can go broke by missing out on the immense wealth that your winning investment was destined to create. Think about it. If you buy a stock at $10 and it goes to $20, you sell it and pat yourself on the back for your 100% gain. It feels smart. It feels safe. But if that stock goes on to become a 100 bagger, eventually reaching $1,000 a share, what did you really do? You made a $10 profit per share, but you left $980 of potential profit on the table. You sold a winning lottery ticket for a tiny fraction of its ultimate worth. Phelps said investors have a terrible habit of watering the weeds and cutting the flowers. What does that mean? When we look at our portfolio, we see a stock that's down 50%. That's a weed. We hold on to it, hoping it will come back to even. And we see a stock that's up 100%. That's a beautiful flower. We rush to sell it and lock in the gain. We should be doing the exact opposite. We should sell our losers that have proven our initial thesis wrong and let our winners run and even add more to them. So, you might be thinking, this all sounds great, but that was back in Phelps's day. Can you really still find 100 baggers today? The answer is an emphatic yes. The principles of business growth and competitive advantage are timeless. Think about companies that have achieved this in more recent memory. Monster Beverage, the energy drink company, delivered returns of over 100,000% from the late 90s. That's a 1,000 bagger, not just a 100 bagger. Or look at a company like Nvidia, which designs graphics processing units. For years, it was a niche company for computer gamers. But its leaders had the vision to see that their chips were perfect for artificial intelligence and data centers. Those who saw that potential early and held on through the volatility have been rewarded with one of the most spectacular 100 baggers of the modern era. The names and industries change, but the underlying story of disruptive growth is eternal. To find these, Phelps was a big believer in what his contemporary, Philip Fisher, called the Scuttlebutt method. This is a funny old word that basically means doing on-the-ground, investigative research. Don't just read the annual report. Go beyond the numbers. Talk to people who interact with the company. Are customers fanatical about the product? Are employees happy and motivated? Do suppliers respect the company and speak highly of its management? Think of yourself as an investigative journalist or a private detective. If you're looking at a retail company, go to its stores. Are they clean? Are they busy? Is the staff helpful? If you're looking at a software company, try to find users and ask them what they love and hate about the product. This qualitative research can give you insights that you will never find in a spreadsheet. It gives you a feel for the business and the strength of its moat in the real world. Now, what about the price you pay? A lot of investors get obsessed with buying things that are statistically cheap, meaning they have a low price to earnings or price to book ratio. Phelps's approach was different. He argued that for a truly extraordinary business, the price you pay is less important than the quality of the business and its long-term growth runway. He wasn't advocating for reckless overpayment, but he was willing to pay a fair or even what seemed like a high price for a truly exceptional company. His logic was that if a company can grow its earnings by 25% a year for 20 years, whether you paid 20 times earnings or 30 times earnings at the beginning becomes almost a rounding error in the final calculation of your massive return. Trying to be too clever and waiting for the absolute perfect rock-bottom price often means you miss the train entirely. As he famously said, the stock market is a very expensive place to find out who you are. Trying to time the market perfectly is a fool's errand. It's far more important to be right about the business. This leads to a final, more advanced point about diversification. The conventional wisdom is to diversify your investments widely across dozens or even hundreds of stocks to reduce risk. Phelps's philosophy flies in the face of this. To get the life-changing impact of a 100 bagger, it needs to be a meaningful portion of your portfolio. If a stock that makes up only 0.5% of your assets becomes a 100-bagger, it's great, but it doesn't dramatically change your net worth. Phelps was a proponent of a more concentrated portfolio, making a few high-conviction bets on what you believe are truly exceptional companies. Now, this is a double-edged sword. It dramatically increases your potential returns, but it also increases your risk if you're wrong. This approach is not for the faint of heart or for those who haven't done their homework. It requires immense confidence in your own research. Think of a championship sports team. They don't win with a roster of 20 average players. They win because they have 2 or 3 superstars who carry the team. In investing, a few superstars can carry your entire portfolio to incredible heights. So, let's tie it all together. The path to finding a 100-bagger, as laid out by Thomas Phelps, is a marathon of discipline, not a sprint for quick profits. It begins with intense research, the buy right phase, where you hunt for small, rapidly growing companies that are protected by a formidable competitive moat and led by brilliant, invested managers. You're looking for a superior business above all else. Then comes the true test, the psychological battle of holding on. This means enduring terrifying market crashes, economic recessions, and periods of agonizingly flat performance without flinching. It means fighting the urge to take profits on your best performers and instead letting your flowers grow into giant sequoias. It requires a fundamental shift in mindset from short-term speculation to true long-term business ownership. The wisdom of Thomas Phelps is not a get-rich-quick scheme. It is a profound, time-tested framework for building lasting wealth. It demands work, it demands courage, and most of all, it demands an almost superhuman level of patience. But for those who can internalize these lessons and apply them with discipline, the potential reward is not just a profitable investment, but a truly life-altering financial journey. It's about finding greatness and then having the patience to let it compound for you year after year after year.